Okay, before we head in, this is the last time for this notice. July 31st is the last date for all-in pricing for the applied level. That is in 3 days, and then it's done. It's 320 US if you're in the CFA community, 440 US if you are non-CFA, and this is for the all-in pricing, meaning that after July 31st, any new modules that are added, you will automatically get them. Purchasing August 1st onwards, you'll get the applied level and everything I add to the applied level, but new modules that I overlay, you won't get. August 25th is the last day for new positions in the market outlook. After that, it moves to the portfolio construction module. In the applied level, you must be an applied level subscriber to access that, to access new positions, not just a portfolio construction subscriber. I had posted understanding ocean shipping, and I put up two walkthroughs of a 10K. I put up one for Starbuck, which is a dry ships, SBLK, and I did one for Frontline, which is an oil tanker company. So we did dry shipping, we did tankers, we just need a container shipping company. Global Ship Lease is the one that I selected, GSL. I did the 10K walkthrough, and then I thought, let me just listen to it, because I've always been uncomfortable with the 10K walkthroughs, because really it's me scrolling through the 10K, reading highlighted sections to you, things that I highlight to show you, where you would find certain things and how you would, progress through a 10K. And also to show you that now that we've watched Understanding Ocean Shipping, we'll see a lot of that language and a lot of that stuff in the 10K. So I highlight a lot of that stuff to show you, look, now you can now understand these sections. But in watching the 10K, even I'm bored. I'm watching it and I'm thinking, okay, I'm not really following, because you're reading stuff to me. I'm talking to myself now. You're reading stuff to me. I can read myself. Why not just give me the 10K with the yellow highlighting that you've done, and I'll read it myself. Maybe put a few notes on the screen. I can read it myself. There's got to be a better way. And I have struggled with this with the 10K, is how do I present this in a better way? Because it is a real life case study. You can't say, oh, you don't need to read it. You must read the 10K if you're going to really know a company. Doing it any other way might take attention away from the fact that you have to read the 10K. So I've been hesitant to move away from it because I don't want to make it sound like it's easier than it has to be. But the presentation, I'm not happy with the presentation. So I'm trying a new format instead of doing a 10K walkthrough. And I'll show you the screen shortly. But all companies are going to follow a basic pattern. I'll start with a company description, and I'll describe the business model. The business model is how it generates its revenues. We'll discuss its revenues and revenue recognition and where it gets its revenues from and how it generates its revenues. We'll look at its expenses and the type of expenses that it incurs. Then over onto the balance sheet, we'll look at the type of assets it has, especially the assets that earn income or the assets that are used in the generation of income, and we'll look at its debt and its equity capital. So the combination of these two is capital. Then we're in a position to look at the balance sheet, the income statement, the cash flow statement, looking at ratios and relationships. And then we can end with a valuation, buy, sell, or hold. And once we have a valuation, we can determine what the appropriate strategy is. For GSL, they don't have liquid options at all. So you're limited in your strategies. It's a straight up buy or sell. And for me, I think it's a hold, which would set up a short strangle. But without liquid options, it's uninteresting at that point. So it's more a matter of, I would buy it at a certain price. So now you must wait for that price. Hard to sell puts on it. Again, the options are not liquid at all. And it's not as if there's a 30-cent spread between the bid and the ask. It's like a $3 spread between the bid and the ask. When I say they're not liquid, you go ahead and put a zero on that. Like nothing trades. Let me show you what some of the screens look like. I'll just show you one of them so that you get an idea of what it is that I'm trying to present. So when we talk about expenses, for example, I go through each of the categories to describe what they're composed of and to see if we can attempt to model, if we were going to forecast it, is there a relationship that we can use? So vessel expense, we know this is a technical ship management costs in the vessel expense, and we can forecast technical ship management because we're given the breakdown of what it costs per ship for the management costs, 19.3 million, plus whatever costs there are, such as crew expense, things like that. That has to be paid directly. So it's management costs plus direct costs, and we can forecast part of it. 2023 we had 179 million, less than 19. It's 160 million. We could divide that by the number of ships. So we have an assumption now of what our vessel cost is per ship, so that if we get a news report that the company is adding a ship in the second quarter or the third quarter, or is recycling a ship in the third quarter, we know to increment or to increase that cost category by a certain amount, or decrease it by a certain amount. For Q1 2024, the expense was 47 million. Let's go to depreciation amortization. Between depreciation, and we know what salvage value is, we know what scrap rate is, we can calculate the amount to be depreciated, we can calculate a useful or the average age of our vessels. We know that useful life is 30 years. We can calculate what's left over. So we can forecast 2024 depreciation, 82.6 million. We can forecast our amortization. This is deferred charges plus our amortization of intangible liabilities. 96,281,000 for 2024. It was 91.7 million for 2023. To see how close we are, Q1 2024 was 24,270,000. If you run rate that, you get 97 million. We're forecasting 96 million. So this is what it allows me to do, is to present some kind of relationships that exist, that if you did want to do any forecasting, it does give you some ideas of how you would forecast each category. There's a description of the assets broken down by capacity, broken down by age, things like that. So hopefully that is a better system for doing it, rather than reading the 10K walkthrough. That'll be up this week. I'm almost done that one. It's far more time consuming to do it that way than to just highlight and read, but I think it's far more rewarding. So once it's up, please leave some comments of if you've done some of the other 10K walkthroughs, leave some comments on whether or not you think that's better. Or if you have any ideas for improvements on that one, feel free. Okay, let's head in. Let's review some of the economic data from last week. On Monday, we got economic activity out of Mexico for May, year over year, for May, backwards looking. Forecast was 1.4, came in at 1.6. So even though it's rear view mirror, it does support the story that economic activity in Mexico has been quite robust. Chicago Fed National Activity Index up 0.05. The expectation was for negative 0.09. It's for the month of June. Later in the week, we got our first look at Q2 GDP, which was quite strong. So this does support that data point. It's in the same direction. Richmond Manufacturing, the Richmond Fed Manufacturing Index on Tuesday, negative 17, following a negative 10 the month before. Expectation was for negative 7, a slight improvement, and it went down. This sort of is in line with a bunch of regional indexes that we've seen. Wednesday, for those in the oil and gas space, crude oil stocks for July 19th, a larger draw than expected, down 3.7 million. The expectation was a draw of 2.05 million. Even with this draw, we can see here in the chart for U.S. crude oil stocks that the blue dot here is the midpoint of the 5-year range. We're well below that midpoint for this time of year, but it didn't support the price. Week over week, oil dropped from 78.60 a barrel to 76.44. Now, I'm not sure if that is the beginning of the reversal of of the political trade that we had seen, thinking that with a Democrat administration, there would be a faster move away from oil to EV. They would be far more supportive of the green transition, and there'd be less demand for oil going forward. Trump is drill baby drill, but as I've demonstrated last week, I don't know that you can drill anymore. The U.S. is producing the most oil it ever has in history. Not only that, they're producing more oil per day than any country has ever produced. I don't know what drill baby drill will do, but there it is. Gasoline stocks dropped 5.5 million. Expectation was for a drop of 900,000. A little bit more supportive of the price here, 241.47 per gallon on the contract, down to 240.46, kind of in the middle of the 5-year range. I don't know that there's much to see here. There's based on inventory, based on days supply, I don't know that there's reason to drop. I don't know that there's reason to increase. Here I'm talking about price. So I think we're sort of range bound where gasoline is. Oil has been sort of moving between 70 and, if you're going to be generous on the high end, 90, but I think that's more 85 within that range. So as we push down towards 70 for Oxy, it makes it attractive on the 57.50s and the 60 puts, because Oxy, of course, as the price approaches 70, the price of Oxy will also drop, because that is the price of their output. Moving into Thursday, big day here. Durable goods for June, month over month, not good at all. Negative 6.6 for June. The forecast was for an increase of 0.3. The previous month was 0.1, negative 6.6. But that was overlooked with GDP, 2.8%. The forecast was for 2%. The previous quarter, 1.4, so you had double the growth rate, 2.8%. I have an arrow here. We will take a closer look at GDP. That arrow's pointing off the screen. As soon as we get through this screen, we'll dive a little deeper into GDP and look at the components. Still within GDP, PCE prices quarter over quarter. This is advance 2.6%. That's Q2 over Q1. The Q1 over Q4 of last year was 3.4, down to 2.6. Nice. And core PCE prices quarter over quarter from 3.7 down to 2.9. Yes, the expectation was 2.7, came in hotter than the expectation. But let's just pay attention to the delta here. We went from 3.7 down to 2.9. This went from 3.4 down to 2.6 quarter over quarter. I think you can call that a victory, even though it's a little over the expectation. Continuing jobless claims, 1,851,000, down from 1,860,000, moving in the right direction. Initial jobless claims, 235. The expectation was 238. Week before was 245. That is supportive of slight improvements. So GDP. Hard to argue that is a good growth rate. The estimate for long-run trend growth rate is somewhere around 1.8 to 2%. This is 2.8. Still a hotter economy. You would say that you have a positive output gap, meaning that your actual GDP is higher than your trend GDP. And at the same time, we're seeing that inflation is coming down to that 2% target. Sort of landing in that zone they call soft landing, right? Let's look at Friday for PCE prices. I don't know that there's much of a surprise here. It comes in below CPI, and we've already seen CPI moderated. We should expect the same thing for PCE. The core PCE year over year for June, 2.6. Unchanged. The expectation was for it to give up something to 2.5, but stayed at 2.6. PCE price index, not the core, but headline year over year, 2.6 down to 2.5, came in as forecast. If we go into a little bit more granular detail, let's look at the month over month for June, 0.2. The expectation was for 0.1. The month before was 0.1, but let's bring it to a couple more decimal places, shall we? The month before was 0.127%, which is more than 1, and this is 0.1818%, which is less than 2. So the difference is not 0.1%, the difference is 0.6%. There is information in that second and third decimal place. If you take last month's core PCE month over month and annualize it, you have 1.53%. If you take this month, even though it was an increase, and annualize it, you're getting 2.2%. Targets 2.2, and we have rates at 5.5. I think it's time. I really do think the Fed has permission to cut on Wednesday. Knowing them and their cautiousness, I think they'll err and make a mistake and not cut till September. I think that would be a mistake. If they tell us that rate hikes work with a lag, so do rate cuts. Why stop? Why wait till September? Why not cut now? Bank of Canada is way ahead of them on this one. Personal incomes. This doesn't get very good. Month over month for June, only up 0.2. The expectation was for 0.4. The previous month downgraded to 0.4, only 0.2. But spending up 0.3. The previous month upgraded to 0.4. So bringing home less. The growth in the income is less than the growth in the spending. It has to by definition hit savings. And you may say, well, what if you had no savings? Why don't you say it increases debt instead of hit savings? It's because we look at aggregates, right? So here is S, that is everybody's savings. If somebody is taking on debt somewhere, that debt has to come from somebody's savings. So that's why we say it lowers savings, or it dips into savings on an aggregate level. But on an individual level, it could be people, spending down their savings or racking up their debt. Michigan consumer sentiment 66.4. That if you were watching at 10, that gave a boost to the market. The expectation was 66, came in at 66.4, but I sort of don't look at the expectations because these are just good guesses. Those are good guesses. 68.2 was the month before, which was a drop. We went from 68.2 to 66.4. So month on month, there is less sentiment, right? Or you could say the sentiment has degraded month over month. Yes, it's greater than what you thought it would be, but the market didn't really seem to react to saying, oh, we think it'll be lower. It just really reacted to, well, not as low as we thought it was. But look, all of these forecasts are best guesses, right? Whereas the previous month is an actual number, this month is an actual number. Actually, we dropped 68.2 to 66.4. Going back to PCE for a minute, the market-based PCE, zero is zero. This is, if we look at core PCE 0.2, if we go to market-based, that includes imputed prices. In other words, shelter, for example, owner's equivalent rent. You have to impute a price for that. If there's no market price, it's just ignored, and it's just looking at the price of things that you can actually see in the market. Zero. The core on that one, 0.162, which is 1.96 annualized as opposed to 2.2% annualized. I think we have full permission for July to actually, the Fed actually has the ability to cut rates. Yes, you have a strong growth, but inflation is going to continue to come down as supply continues to increase. Okay, let's dig into GDP a little bit more. It was actually 2.84, made up of the consumer adding 1.57. And this is contributions to the 2.84. This is a growth rate, 2.84%. If we just counted the consumer, GDP would be 1.57. Investment, 1.46. Government, 0.53. And the trade deficit took some growth away. 1.57 on the consumer goods, 0.55. Services, 1.02. We're starting to see some growth in goods. Durables, 0.35. Non-durables, 0.2. There's no fault you can find in the consumer over here. If we look at the trend, this is the previous quarters. This came in at 1.57. Q1 came in at 0.98. For last year, Q4 was 2.2, Q3 was 2.11, Q2 0.55, Q1 2.54. So if you look at a year over year, 1.57 versus 0.55, quarter over quarter 0.98 up to 1.57. Hard to argue with Q2. For investment, 1.46. Fixed investment up contributed 0.64. Change in inventories 0.82. For government spending, federal 0.25, state and local 0.28, defense 0.19, non-defense 0.06. All positive, all positive. For the trade balance, exports up 0.22, both in goods and services. However, imports taking it away, right? Negative 0.93, goods negative 0.84, services negative 0.09. You may be looking at that and saying, as Trump would say, how can we make sure that that's produced in America? And I've given this example before, I'll give it again. Why would you? The question, that would be the question, is why would you want to bring it back to a country where it seems you're running a pretty good labor market as it is? You can't both shut down the border and bring back all the manufacturing at the same time. That would be inflationary, because who's going to do the job? So I am a busy person. I have a house. There is my property. Here's my house on the property. I have grass in the front. I have turf in the back, so it doesn't need to be done. But I do have a pool back here as well. If I had to cut the lawn, if I had to clean the house, and if I had to manage the pool, there are higher performing things that I cannot do. Higher value added things I do that I couldn't do. I would have to take hours away from that to do this stuff. So you can think of my house as a country, and I am importing these services. So that if you look at my GDP for a given month, you would say, okay, well, we can see the level of national income that you made, household income, minus these expenses, these things you're importing. Can't you get rid of this negative number? And I would say, well, yes, I can, but don't expect my national income to be as high, because I'm going to have to take time away from higher productive things to do these lower productive things. Capitalism is very efficient at allocating capital. If capitalism over time has allocated capital such that this is the scenario, it is very likely that this scenario exists to support this scenario over here. That if you said, well, let's fix this, you might have huge drops over here, because you would either make things extremely pricey, you'd either really push inflation up, or you would have to reallocate away from high value added activity to low value added activity. So I think it's a naive approach to say we're going to stick tariffs on all of this stuff and we're going to bring this stuff back to America. It would be like me saying, I am done with this nonsense of paying someone to clean my bathrooms. I'm going to do it myself. I'm going to cut my lawn and clean my pool myself and screw everything else. I'm just not going to do this other stuff. It would be foolish. And I think that's, I don't know that we can look at this and say that's a problem. I would say more than likely this is supportive of everything else. All right, let's look at the effect in the markets of growth that is nothing to complain about, and decreasing in pricing heading towards the Fed's target. That is nothing to complain about. So on the macro level, nothing to see here, and it's showing up in yields. The 1 year down to 4.79. Look at the 2 year down to 4.36. The effective federal funds rate is 5.33. That is 100 basis points lower, and this is typically how curves uninvert. is you have a money market curve. There's the 2-year. This is the start of your capital market curve. It starts to price in rate cuts. The 10-year drops as well, but doesn't drop as much. So you go from an inverted to an upward sloping curve. Negative 16 basis points. Look at that. That was an increase of 8. So when we say the curve uninverts before the recession, typically economic activity starts to decline. The 2-year starts to price in rate cuts while the 10-year still drops. Look at the 10-year drop 5 basis points, but the 2-year drop 13. The 2-year drops at a rate faster than the 10-year, usually in front of a recession. This is usually because most inflation is demand driven. This inflation was supply driven, so the rules that we have seen in the past may not apply. What's our other inversion? The 3-month to the 10-year, still over 100 basis points, 118. No change over here. Long periods of time on the inversion. Canada actually has a slightly less money market to capital market inversion because, well, we had another 25 basis point rate cut, 50 basis points done. I think there's 50 to go. At the beginning of the year, I had thought that it would make sense for interest rates to be about 100 basis points lower by the end of the year. And we've got 50 of them done. I think we got 2 more rate cuts ahead of us. The economic data out of Canada is not as good as the economic data out of the US. And again, we do have a consumer and a household that is far more interest rate sensitive because of the nature of the mortgage market than you do in the US. I expect the Bank of Canada to continue, but I expect the Fed to move as well, which means that the interest rate differential between Canada and the US, I think at this point is probably as wide as it gets. I don't think it gets any wider. So we'll talk about the Canadian US dollar pair. I am looking at going long the Canadian at a key point. Small little runoff from the SOMA down to 6.64 trillion from 6.64 trillion. Woohoo! Balance sheet down 2.79 billion, but this was 3.7 billion runoff, so a $924 million increase. Ooh, look at that. Big moves. This is going to be like watching paint dry on this one. Money market funds decreased 11.81 billion. Maybe we've hit the peak here, so we're going to start to see this kind of volatility in terms of what's going in, what's going out, what's going in, what's going out. Retail down 3.72, institution down 8 billion. Both down on government, retail up on prime, institution down on prime. Big week for risk. Let's have a look at what the calendar is showing us here. July 31st, in 3 days, the big boy, FOMC. Odds are, I shouldn't say odds, I keep saying that. Probability is that they're going to do nothing. 95.3% unchanged from the week before. I'm still 60-40. I still see plenty of permission here to go ahead. Yes, I see some. The 60% is more based on, observing the Fed and how careful they are. And they don't want to make a mistake by cutting too early. But I think they risk a mistake by cutting too late. So I think the 60% that I put in here is heavily skewed towards the character of the Fed, and the 40% is, come on guys, look at the data. You're good to go. Moving out to December, look at the change out here in December. You have a 4.25 showing up now. 1 or no rate cuts from 6.4% down to 2.4%. Look at this, 4.75, that's 3 cuts, was 49.5. The weight of the probabilities is on 3 rate cuts, 58.5%. In 2 days, Mexico, GDP, Q2, preliminary look at Q2 GDP. Canada, in 3 days, GDP, a preliminary look for June. It's monthly in Canada, quarterly in Mexico and the US in 3 days. And the unemployment rate in Mexico we get in 5 days. Treasury refunding we get in 3 days. Look what's going on here. You get the refunding in the morning, you get the FOMC in the afternoon. Huge risk day for yields. JOLTS in 2 days, ADP in 3 days. You also get the Employment Cost Index, the true measure of wage inflation, in 3 days. Productivity and unit labor costs we get in 4 days, and jobs in 5 days, every single day. Other than Monday, every single day there's something going on. If you're in the peso, you have 2-day risk over here. And we do have some JOLTS, although this is becoming less and less important. Thursday is going to be big. You get your ECI along with your Treasury refunding, along with the FOMC, and of course in Canada you're also going to get your GDP. And then Friday, Jobs Day on both sides of the border, Mexico and US. And then next Friday, Canada jobs. Effective federal funds rate still sitting at 5.33. Reverse repo, really nothing to see here, an increase of 1.4 billion. The TGA is up 21 billion. Reserves are down 46 billion. And if we look at 2.5 trillion as ample, sorry about all the beeping back here, but that's what happens when you're surrounded by Apple product. At 40 billion a month, look at that, under 30 months now, 28.92 months. Okay, real rates and break-evens, flat term structure from the 5-year out to the 10-year, and break-even rates have all pulled back single-digit basis points, but that's in the right direction. Looking at Fed funds futures, some excitement here. Q3 pricing in 28.5 basis points of cuts, Q4 41 for a total of 69.5 by the end of the year versus 25 based on the midpoint of all the projections. It's pushing up to 3 rate cuts this year. Q1 37 basis points, so over the next 9 months 106.5. That's 4 1/4 cuts. TLT, not bad for the week, not good, not bad, up 0.08. SPX down 0.83. Implied volatility coming back nicely. Look at that, 13-week IVP 65th percentile, up from the 49th, so there is some premium to be had. The 26 week is 49th percentile, up from 36. As I had reported last week, sold the 93 puts for August for $1.39. We're just under $93 now, $92.95. On the dip earlier in the week, I did sell the 91 Septembers for $1.71. I'm becoming more and more confident that the low 90 range is the support area for TLT. Rate cuts are imminent. It's not as if, well, when will we get rate cuts? Will they cut this year? Will they cut next year? That's not the question. It's just, when will they start? Will it be July or September? And once they start, I think they'll be pretty much like the Bank of Canada, consecutive meetings. So I'm going to continue believing the low 90s range is going to be supportive for TLT until something comes along that changes my mind on that. Mortgage rates, a little changed, 6.78, up 1 basis point over the week. 10-year Treasury was up 7. Spread increased by 7 to 251. Mortgage REITs not doing very well. Agency and Annaly both gave up some ground, but ABR shaking off that DOJ FBI investigation, coming up nicely. They have earnings coming up. I can't seem to find the exact date. I kind of am suspicious it's this Friday, but I'm more like 49% this Friday, 51% next Friday. If I had to pick one or the other, I'd probably be picking next Friday, but for some reason I seem to think it's this Friday, but we'll find out. Housing stocks just still going. DHI up 178, Lennar 3.38, Pulte 4%, KB Homes almost 5, Toll Brothers 6, and look at this, making a mockery of the stock market, up 20%. XHB up 4.29, ITB up 4.21. This is over a week. These are ETFs. Unbelievable. When you have a market, SPX, that was down almost 1% over the week. Look at these gains. The REIT index 6.57. If you're looking for where interest rates are going to show up, it's going to show up in real estate, it's going to show up in utilities and in banking. However, we do have some problems with some specific names. PLD down 0.86. This is in line with SPX, but Digital Realty down 6.14. Nothing to see in OAS, and when I say nothing to see, I truly mean nothing to see. 2 basis points, 1, 2, 2, 0, 1, like nothing to see in OAS. And I've heard some chatter in Bloomberg over the week of widening credit spreads, and I think, what are you looking at? Please tell me what you're looking at. Maybe I'm looking at the wrong stuff, but I don't see anything going on in credit spreads, unless maybe they're referring to private credit, but I don't see anything going on here. Existing home sales, we got that earlier this week for the month of June, down 5.4% month over month. Mortgage apps down 2.2%. New home sales down 0.6%. I think what we're going to see here is, a little bit of game theory. Is the more there is an expectation that rates are going to come down, the more we expect the Fed to cut rates, the more people will say, well, let's just wait a little bit before we lock in a mortgage rate. Let's just wait. So I think that these will probably be slightly negative for a while, and I think there'll be pressure on existing home sales for a while, which means inventory is going to build while people wait for lower rates, which is going to put downward pressure on pricing. Let's find out if that has already been going on. We get the housing pricing index for May on Tuesday, and you get Case-Shiller. And then pending home sales for June is on Wednesday. All right, new positions. A lot to talk about here. When I started this week, I thought, well, I'm going to have to talk about GM. I'm going to have to talk about Ford. I'm going to have to talk about Tesla, Lamb Weston, Stellantis, NextEra. And I thought, I can't go through all the earnings reports. I am taking positions in stocks related to the earnings reports. So let's talk about them and wrap them up with new positions. How's that sound? So there's a lot on the screen here. Let's start with currencies. The U.S. Mexican pair. I am short the U.S., long the peso, and for a market quote in this form, when you are long the second pair, you're selling the pair. So I'm short the pair at 18.225, which means I'm long the peso. And I'll be looking to add more in the 1865 to 19 range. It has been to 19 twice, but never broke 19. And here last week it touched 1850 a couple of times, but never broke 1850. So if it does, I'll pick it up in the 65 to 19 range. I think this is related to yen strength. The most lucrative carry trade over the last couple of years was short the yen, long the peso. Borrowing at almost 0%, investing at almost 11%, and a currency cross where your funding currency was expected to depreciate and your investment currency was expected to appreciate, and boy did it ever. So with some yen strength, it's not surprising to see some peso weakness. I think that's limited. The underlying fundamental story to Mexico is still in place. It does have a nice money market yield, economic strength, lower labor costs than China, and proximity to the U.S. That story is still in play. So there we are for the peso. For the Canadian, same thing, long, short, U.S. CAD. I don't have this, but I will short U.S. long CAD in the 139, 139.5 range. I am already inherently long the Canadian because of my exposure to Canadian apartment REIT, so I am long the Canadian to begin with. I would look to add to that in the 139, 139.5 range. So sell US, buy Canadian. There's a negative interest rate differential in there. I would lose more in money market rates on the US than I would earn in Canada. But at lower rates, other types of REITs become interesting in the US. REITs that have a yield higher than the US money market rate that I think can appreciate. that are more on the mall side, not covered malls though. So I don't know that I want to, identify any of the targets just yet because I'm not sure of them. They have earnings coming up. I want to see what earnings and what guidance is first, and then maybe in a couple of weeks I'll be introducing an expanded set of REITs. But if I am going to build Canadian dollars, they are going to go into something because I'd be faced with a negative interest rate differential. The reason I'm doing this is because I don't think interest rate differentials get much wider than where they are now. Bank of Canada's cut twice. I expect them to cut another 2 times. I expect the Fed to cut at least 3. So the interest rate differential will actually decrease. So the Canadian should strengthen based on that by the end of the year. Let's go into equities. TLT, as I've already said, I have the 93 August puts. I now have the 91 September puts. 139 on the 93s, 171 on the 91s. Oxy, I have the 60 puts for August, the 62.50 puts for September. I got 127 on the 60s. For September, I got 305. If oil does retrace down to the lower 70s, Oxy probably would break 60, maybe even 59. I would be more than interested in the 57.50s. IWM, I am just short. I shorted it. I am short at 223.95. IJR, I am short at 117. I'm more confident on the IWM short than the IJR short. I'm basically shorting small cap stocks. This is just not the environment for it. They do well when rates are being cut. They haven't been cut yet. And if we look at the chart, IWM, you look at a 2-year chart, they're at 2-year highs. They were going sideways and then they just went straight up, like just straight up. That doesn't hold. I don't think, and you have what the highest proportion of unprofitable companies in this index ever, and I believe the highest proportion of companies whose cash flow does not support their debt. So that's not good. And IJR, yeah, they're profitable, but they're still small cap. So I took a short on both of them. IJR did the same thing, just went parabolic straight up. Disney, 85 puts for August. I got 118. Maybe a little overdone on Disney here. ABR, I bought 1750 calls for January of 2025. They cost 30 cents. If ABR does well, good earnings, and they calm the market down over the DOJ FBI probe on their earnings, they should get a nice boost, especially with the 10-year coming down. Anything under 4.25 is supportive of their business model. Anything under 4 is really supportive. So they could get a nice boost. I'd be winning right away. If on the other hand they earnings are okay because it's still a tough environment. If the 10-year is still hanging around the 420, 430 mark, and they just keep saying, well, we're confident that we didn't do anything wrong. I don't know that we're confident is good enough at this point. I think they really have to come out and say this is ridiculous, and really put it to bed. If they drop, I will fund this 17 call with a put somewhere. Right now, you got to go very deep to get 30 cents out of puts for that month. Hopefully, if there's a move below 13 back into 12.50 down to 12, maybe I can get the $5 or the 250 puts going into January. There's just no liquidity on them. That's the problem, is there's no liquidity. So maybe with some action there might be some liquidity. But look, I'm funding 30 cents. It's not going to take me long to get done. CapREIT, I have put a short strangle on. I got 70 cents for September. The 45 put, 52 call. Sold the 45 put, bought the 52 call for September. I have 64,000 shares. It's more than I would want, so I want to unload some anyway. So I did 100 on these. That would be 10,000 shares. My effective selling price would be 52.70 on 10,000, and if it was put to me, I'd get it at 44.30. I'd be a buyer there of more anyways. COMEX, I had the 43 put. I now have the 42 put. I don't know if I reported that last week for August. 84 cents and 85 cents are the prices that I got. Let's move over to GM. I was buying shares on the way down and also selling the 48 calls against them. So I have a covered call position at 48 for September. Average price 47.02, 129 on the calls. And then I have laddered on the way down. The number in brackets is the quantity that I sold. 48 puts, I got $1.94. This is for September. September 48 puts, I got $1.94. 47 puts, $1.89. 46 puts, I got $2.10. 45 puts, I got $1.84. 44 puts, I got $1.66. 25, 50, 100, 150, 200 contracts representing 20,000 shares. In August, I still have the 45 puts for 51 cents. I got 25 there. On the call, I think that investors paid attention to the wrong thing. They said that they were slowing down some of their EV stuff. Well, the market for EV is saturated and you got a price war coming. So why invest at top dollar? Why take CapEx, invest at top dollar for what would seem like for the next few years a tough market in the EV space? I'm with that. If it were me, I would have said, let's slow this down a bit. Also have decided to swap out for their cruise division, swap out the Origin for a Bolt. The Origin is a purpose-built vehicle like Waymo's, where you have no steering wheel, no pedals, and they pointed to a regulatory environment. Elon Musk fired back and say, well, no, that's not it. It's just that they can't do it. Yeah, but neither can they. Neither can Tesla. If Tesla could do it, they would do it. Google is way out ahead on this one. Some 20 million miles being done and generating revenue. So they're going to use Cruise, which is supportive of sales of EVs from GM. I see nothing wrong with that. I'm to put a level 5 vehicle out there when you don't have coast to coast level 5 driving, when you just have geofence level 5 driving, why not? Why invest in that? By the time you have level 5, maybe that purpose-built vehicle is something different. Maybe it looks like something else. So I'm okay with that. Market didn't like it. But this is what it missed. Paul Jacobson saying we have 1.14 billion shares outstanding. Our goal is to get under a billion. That's 12.2% lower. Just at current market cap, if market cap didn't change and you bought back 12.2% of your shares at the current market price, that would put the remaining shares at a little over $50 a share just on the buybacks. So he announced that is where they're going by the end of the year. And then he followed it up. We will continue with the buybacks. If the market doesn't recognize our valuation, we will continue with the buybacks. GM's guidance was a range of 950 to 1050 on earnings. Take the midpoint of 10. They're trading at 4.4 times forward earnings compared to Tesla's 70, 80 times forward earnings. GM is more profitable per car, generates more cash flow per car, has significantly more cash flow than Tesla on all margins, seems to be beating Tesla altogether, and is only trading at 4.4 times forward earnings. GM has a robo-taxi, Tesla doesn't, right? So, and speaking of that, I don't know why Tesla just doesn't buy GM. If they did, they could survive an EV price war because they have an ICE cash cow. The cash flow off the ICE side is I think, what are we talking about, 4 to 5 times Tesla's cash flow. So right away you have a ton of cash to use. You can swap out the Cruise for a Tesla, and guess what you have? You got a robo-taxi business. You got a robo-taxi business right away. You can combine Tesla's generalized solution, which is coast-to-coast self-driving, with Cruise's geofenced solution, which is a specific solution to a particular area, and meet somewhere in the middle. Tesla picks up a Roadster, you get Corvette. Trying to put a Roadster back on the road, you don't have one. There's an E-Ray, which is a hybrid Corvette, and they want to go all electric on it. You pick up Cadillac, you pick up Corvette. I mean, and it's only, what, $50 billion. Tesla could issue 10% more shares, take GM out for, what, $75 billion, and own them and own that cash flow. To me, why they're not being taken out by somebody somewhere doesn't make any sense. 4.4 times forward earnings and a threat to continue to buy back shares if the market doesn't give it a valuation. I guarantee you, with that cash flow, they're going to do it again. You get to you get to the fourth quarter, you get to their earnings in November, and if they're still being disrespected by the market, they will do another 10 billion. They will do another 10 billion accelerated buyback. So I am loading up on this one for a couple of reasons. Number one, they're the best of the North American lot. Their profitability and their cash flow is way above what the other North American companies are offering. Their margins are better than Tesla's margins. Number two, they've threatened to buy back more shares if they don't get the valuation, and they're going to buy back right now, in the books, another 12.2% of their shares. Now, Stellantis said that any of its brands are up for closure if they don't start performing, and their worst performance is coming from the Chrysler division. They got problems in North America, lost significant market share. You shut down some of those brands, you open up market for somebody else. GM would be the clear winner. Ford's quality sucks. I think we've known that for a while, and their earnings show that with the warranty repairs that they had. I own a Ford. I can tell you the quality just isn't there. And they cheapen their vehicles. That's how they get more mileage, is they cheapen their vehicles so that they can maintain their fleet mileage. It's not surprising to see that Ford suffered. I said earlier in the year I wouldn't touch Ford. That if I had to pick one, it would be GM. I wouldn't even touch Ford. I didn't even touch Ford. I saw it pull back before earnings, and the motivation might be, well, let's sell a put here. I thought, no, I'm not selling a put on this thing. And I was right on that one. GM is moving way up on my conviction list. I'd say it's probably number 4 right now, and if it pulls back to 43, 42, 41, it would be in my top 3. Cap rate would drop a bit because, well, it's pushing 49. Once you get to 50, 51, you become less convicted of it because it's getting near what you think is fair value. But GM is way below its fair value, and you have a CFO that threatened on the call to buy back more shares if the market didn't respect it. Someone's going to be a buyer this year. Whether it's the market or whether it's GM, someone's going to be a buyer. I want in front of that. AT&T, I want the January 25, $20 calls. They're currently 70 cents. I want to combine it with the 17 puts, which are currently 40 cents. So if I did a risk reversal where I'm selling the 17 puts, buying the 20 calls, it's going to cost me 30 cents. But on Friday, AT&T had some weakness. If the Fed does not cut rates on Wednesday, I think you're going to see more weakness in AT&T because, of course, it will be priced kind of bond-like. Because its cash flows are kind of bond-like. It will be priced that you might dip down to 1880, 1870. At that point, this might be enough to bring this down to maybe 60 cents. It might be enough to bring this up to 50 cents. If I can get, a 10-cent spread on it, then yeah, I will. I'll probably want to do 200 of those. ZB, this is the 30-year bond. September, I will sell puts on any Fed weakness. The Fed does not move on Wednesday. If the bond market reacts negatively to that, I think that's short term. I'll sell more puts on TLT, and I'll go even more on the leverage, and I'll sell puts on ZB. Okay, Lamb Weston. no sugarcoating those earnings, especially with the forecast coming in well below what expectations were on a going forward basis. To set this up, I need to sort of tell you a story between two stocks, Ford and Lamb Weston. I didn't sell any puts on Ford. After I saw earnings, would I buy the stock after an 18% drop? Nope, because I think this is a Ford problem that continues on. I said earlier in the year I wouldn't touch Ford. I've said that several times. After seeing their earnings, this is not something that is easily fixed. This is a Ford problem that's going to continue for a while. I think it's highly probable Ford breaks 10 and in time finds its way back to the $7 mark. So I wouldn't touch it. Let's move over to Lamb Weston. If I didn't sell puts on Lamb Weston, if I had nothing on it, and after earnings I saw the price in the mid-50s, would I buy it? Yes. That's the difference between the two. Had I sold puts on Ford after I saw the earnings, I would have said, okay, I'm out. But having sold puts on Lamb Weston, having seen the earnings, I'm not out. I'm in even more. The price reduction was necessary, but it was an overreaction. Whenever you have something like that, it's not uncommon to see actual upgrades on the stock given the current price. So I'm just going to drag this onto the screen. JP Morgan maintained, this is in the morning on the 25th. You can see the time that I took the screenshot, and this is off my news feed. JP Morgan maintained Lamb Weston coverage, overweight, target of 63. Lamb Weston here was under 55 at this point. Stifel cuts to hold from buy, price target to 60 from 115. Goldman Sachs maintained Lamb Weston coverage with buy, target of 78. Citigroup cuts target price to 72 from 104. TD Cowen downgrade to a hold, target of 61. Bank of America coverage with neutral, target of 66. So you can see the overreaction actually caused some firms to say, let's upgrade this. So they weren't upgrading the company based on its earnings. They were upgrading the company based on, well, at 55, this is a buy. At 75, maybe we weren't that excited about it. At 100, maybe it was a sell. But at 55, it certainly seems like a buy. And I agree. Whereas with Ford, even though it's gone from, $14 down to $11, I still think it's a sell. So I wouldn't touch it. I have been asked this before. If you're in a loss position, why not just move on? Make your money somewhere else. And my answer runs along the lines of this. Going from negative 40,000 to zero is the same as going from 0 to 40,000. So is there a path from negative 40,000 to zero? Because that's basically what I was down. 72.50 puts for August. I had in front of earnings. I got $1.50. These will be assigned at 71. I don't see how this company gets above 71 by August in the next 3 weeks. I'm just not seeing it. So they will be assigned at 71. At one point they were 55. I was down over 40,000. Based on the closing price, that position is down 35,000 on an expiration date price. Assuming they are put to me, I pay 71. Based on the current price, I'd be down 35,000. But I would be a buyer at this price. If I didn't have any position on Lamb Weston, I would look at this price and say, oh, I got to buy at this price. I'd be selling puts on it at this price. If you know what you're in when stocks have really big down days, volatility spikes, but that spike doesn't last very long. Volatility will stay elevated, but what happens with IV is it spikes and then it sort of does this throughout the day. Here's where you want to get those premiums. I knew what I was in, and when I saw the drop right away, I said that's a little much, and it continued. So I said, okay, I'm gonna take advantage of this spike. 60 $60 puts for August. I got 270. I did another 25. I had 25 of these. Continue to fall. 55 Septembers for 230. I got another 25 of those. And then it fell a bit more. I put some 50 puts on. It recovered. I then added the 60 calls to make this a short straddle. I got 230 for that. So here is the outcomes. In August, it will either be above 60 or below 60. So there is August greater than 60. Here's August less than 60. I put a 75% probability on that. And if it is above 60, then this $60 put, I get to keep the 270. That lowers my average price from 71 down to 68.30. Good enough. I have an underlying that's over 60, and I'm at 68.30. That does work to minimize some of the loss that I currently have now. I think it's more likely it'll be under $60, which means these will be put to me as well. Average price of 57.10, average price of 71. I'll have 5,000 shares at an average price of 64.15. Those are the two scenarios for August. It'll either be above or below the strike. Let's move out to September now. Let's assume August was greater than 60. And let's say September is greater than 60 because I have the short call over here. I got the 55 put for 230, and I got the premium for the straddle at 230. That's 460 that I get. Average price of 68.30. 25, because I did 25 of these. 25 would be called, but I have 2,500, so I would be flat. I would get a loss of 370 per share. Currently, right now, if I leave at 71 at an assigned price of 71, being that the underlying is at 56, you're talking about $13.30 loss versus a $3.70 loss. So there's 25,000 to be gained from that in what I think is a worst case scenario. So I'll take it. Well, I shouldn't say worst case scenario, but August above 60, September above 60, I would lose close to 10,000 instead of 35,000. If it finishes below 60 but above 55, I get the $4.60. This drops, my average price here drops to 63.70. So that's not bad. Let's go to the more probable scenario that it finishes below 60 in August. There is my average price. I now have 5,000 shares. September, it finishes above 60. I get 460 again. 2,500 shares would be called away at 60, but I get 460. So 2,500 shares would be called away at 64.60. I'd make 55 cents per share on half that position. I would be left with 2,500 shares at an average price of 64.15. I would go out to August because we're above 60. I'd go out to August and look at what the 65 calls are and sell 65 calls against that position. If we finish below 60 but above 55, nothing more would be put to me. I get to keep the 460 on this. I would drop from 64.15 down to 59.45. Per share. I put a 50-50 chance on this happening. So my probabilities are it's 75% probability I'll be in this situation, and then I put a 50-50 on it being above or below 60 by September. Usually when you have a sell-off like this, it continues on for a while. The stock's under pressure for the first month, the first five weeks, maybe 6 weeks. Then it starts anticipating that because guidance was lowered so much and the price had been beaten up so much that the next quarter was definitely going to be a beat. People start thinking maybe guidance was lowered so that they could beat the next quarter, and then more belief will be that they are going to beat and the price would begin to rise. That's why I put a 50-50 on this of being above 60 or below 60, but a 75. I think the most likely path is it's going to be put to me below 60. I'll have 5,000 shares at 64.15. 2,500 will be called away from me. I'll get 55 cents a share for that, and I'll be able to go out to October and sell the 65 calls or not, depending on what the price action is or what the news is or what the feel is. Maybe I might not. but that's what I'm doing with Lamb Weston. I think the important thing here is this, this does take some time, or I should take some time to lay this out properly for you. I think all too often we're drawn into strategies. This website says if you follow our trading system, it'll flash buy and sell signals and off you go. We have a trading system for currencies. We have a system for this, a system for that. And everybody that is doing that kind of stuff is trying to sell you a strategy. Here's a strategy that works. Here's another strategy that works. And whether it's based on technicals, which it usually is, or whether it's based on some kind of option setup. I know there is one company that likes to sell the concept of the short straddle, that you sell the 10 delta call, 10 delta put, and you take gains at 50%, take losses at 100%, and just rinse, wash, and repeat, and you will make money over time. They sell you the strategy. That's wrong. It would be like me selling you a hammer. You say you want to build things. I say, okay, well, here's a hammer, and I'm selling you the strategy. Here's a hammer, but I'm not selling you the source that you would use the hammer on. There is no one strategy that you can use all the time. If you pick the right underlying, then you can have a number of strategies that work on it. So rather than have systems and strategies, you should have process. Find the right underlying first. Find a stock first and really get to know it. And no matter what it does, you can then switch your strategy on that underlying, because you'll understand the stock, as opposed to having one strategy and hoping all these stocks fit into that one strategy. You can have one stock and you can apply a bunch of different strategies to it, as long as you know the stock. So to go back to what I said earlier, Lamb Weston and Ford, had I sold puts on both of them, I would be walking away from Ford with a loss, saying I'm done with that, and I would be leaning in to Lamb Weston like I'm doing, because I would have been a buyer at the lower price anyways. With Ford, all I could have done was sell in the money calls, knowing that all I'm trying to do at this point is recover some of the loss that I have, but I have no belief in the stock itself anymore. And that's all you can, if you're trying to recover the loss from something like that, that's all you can do, is either short the stock directly or sell in the money calls. And that would, it wouldn't really recover much. It would just make sure that you don't lose any more. Where with Lamb Weston, I know it well enough that I know that I can recover on this one. So, make a long story longer. Invest your time in stock picking, not strategy picking. On SPY, the all-time high, 564.40 from July 16th, still in play. There it is, right there. We're 544.40. The market did come down. It did find support on the 50-day moving average, and on Friday closed above it. The 50-day moving average this week now has moved up to 542.359, which is 0.38% below where the market is now. The 200-day is 8.75% below where the market is, 496.80. It is a Sunday at about 11 a.m. as I do this. I don't have the benefit of seeing how futures are opening on Globex or what the tone of the market is. So if I had to do a straight up and down bet for Mondays and Tuesdays market action, I would have to go long. The GDP report from last week, you can't argue with that. You can't argue with that. You have a strong base. Things just don't fall apart overnight unless you have some kind of big external event, which we have not had. You have prices still coming down. You have all the reason for the Fed to cut rates this week, but given who they are, they're probably going to signal that they're going to cut in September. I think that leads the day, and as long as earnings don't fall apart Tuesday and Wednesday, I can't see why the 200-day would be in play. I think the 50-day moving average is going to be supportive. Maybe you don't have a big rally, but I can't see breaking much below the 50-day unless the Fed comes out on Wednesday and says, we are not confident yet. Then now September's a big question mark. If they say that, then that I think could be negative enough to push through the 50-day and maybe head to the 200. I don't have that feeling though. Forward 4-quarter operating earnings, LSE, SPGlobal, both of them down slightly, not much, but down, 259 and 258. Closing SPX using the average of the two earnings, 21 times forward operating earnings, down from 21.22. Surprise factor is given back, was 5%, now it's 4.4. Remember last quarter earnings was 8%. We were running 5%, now we're running 4.4. So earnings are sort of, heading into the slowdown in terms of their growth. Implied volatility coming back. 13-week, 97th percentile. A 26-week implied volatility, 93rd percentile. And over the last year, we're sitting at the 83rd percentile. So if you want to play the options, there is some premium there. For earnings coming up, LSEG says 171, Sector Spider in the neighborhood. I think that's the best we can hope for now. If they're not in the same house, in the same room, at the same table, at least be in the neighborhood. 164. SPGlobal is just in a different city, so we'll just ignore that one. We'll use Sector Spider to see what's coming up because I like the ability just to click on the sectors and look at earnings by sector by day. Okay, on Monday, onsemi is reporting consensus EPS 92 cents. They're tied to the auto industry. It has not been good being tied to the auto industry lately. And NXP last week, also tied to the auto industry, did not do well. So careful there. There is risk. If you don't want to sit in front of that risk and you do have positions, either close them or understand that you do have some potential risk with onsemi. I'm not closing my positions. I'm good with that. McDonald's reporting as well. Let's go into Tuesday. I've got them sorted now by the sector for XLC Match Group. Match has some interesting stuff going on. They have an activist shareholder who's laid out a plan of how to unlock value there. Expected to report 48 cents. Electronic Arts in energy, only Phillips 66. In financials, PayPal 98 cents. I just don't see a long-term story for PayPal. I'm still bearish on that one, sort of long-term. I think in a couple of years it's going to be just kind of like a Barnes and Noble. Why does it even exist? SPGlobal, come on, man. Yeah, I mean, if their data is anything like their earnings calendar, you can't get that right. Anyways, 364 is the expectation. XLI, the industrials, you got a bunch of companies in there. XLK, Microsoft on Tuesday. First Solar, if you're into that space. AMD as well. For staples, Procter & Gamble, AMD, Cisco, food delivery. This is to restaurants. Now, given that Lamb Weston pointed to the restaurant business as being the weak link in there, Cisco could be a wipeout as well. Expectation of $1.38. Here's the correlated risk you have. If Cisco is also a wipeout, and their forecasting for that sector is down, Lamb Weston could also begin to trade down again on that. But if Cisco comes out really in line or quite well, it may give a boost to Lamb Weston. That the belief might be, well, maybe they just lowered their forecast so much so they could beat the next time. Maybe they did that. If you're into Lamb Weston and you want to see a correlated trade, Cisco could be one. For real estate, you have Essex Property Trust, American Tower. American Tower is their big customers are the cell phone companies, AT&T, Verizon. Utilities, what do we got here? Healthcare, Merck, Pfizer, and then XO, Starbucks. That'll be an interesting one. Wednesday, Fed Day. XLB, XLC, Meta, T-Mobile. We've already seen Verizon and AT&T. We have Meta as well. Meta's been under pressure. The more that we think that Trump is going to win, the more we recognize that Trump is vindictive. The more you remember that Meta kicked him off. He's going to want to get even. Let's see, you have energy, you have the financials. Anything jump out at you here? MasterCard, AIG, for industrials. What else we got in here? Anything interesting? Generac, Train, Johnson Controls, Boeing, that'll be interesting. Western Digital, Qualcomm, there's a big one. Qualcomm, Lam Research, XLP, Kraft Heinz, real estate, Avalon Bay, Mid-America apartment communities. So if you're into the U.S. apartment or U.S. residential REITs, there's two big ones. In healthcare, I'm not big on the healthcare space. Humana is a big one. Borg Warner, if you're into that one. I have puts. I'm long Borg Warner. And I have puts at 32.50 on it as well. Let's see, for Thursday, who have we got? Anything interesting in energy? ConocoPhillips for financials, Prudential, industrials. You've got, I don't really play in this space. Cummins, which is tied to the, they make engines, big in Class 8. And for technology here, the tech sector, microchip technologies, Motorola, Intel, there's quite a bit here. Apple, there's a big one on Thursday. Going into consumer staples, Monster Energy, Hershey, Kimco Realty, Iron Mountain. Iron Mountain has, how could you call them? They're not really data centers. They're document storage. They have a lot of, they're really big in the document storage space, at least from what I can recall of them. Lots of utilities. So if we're in the XLU, look at all the components of the XLU that are reporting on Thursday. I have a synthetic on XLU, and I have puts, 70 puts on XLU as well. Utilities are one of my top 3 conviction trades. Especially with earnings coming down and with more and more going digital and the rise of data centers. Utilities are big. Well, you've got a whole bunch of XLU risk on Thursday. XLV, lots of activity there in XLV, and XLY, Amazon on Thursday. So you got some big tech names this week. Going into Friday, we only have 7. Chevron and Exxon in the XLE sector. Other than that, nothing that I'm really into. And that is it for earnings. It is a big week for economic data, for monetary policy, and for earnings. So you have both beta risk this week, heightened beta risk, and heightened duration risk this week. If you need to hide, well, there's money markets.